Lyft, 13% RIF, 700 employees like our yesterday. Stripe, 14% RIF, 1,000 employees. Opendoor, Chime, Dapper Labs, all hundreds of employees. Opendoor, the most significant, they're 550, 18%. Dapper, 22%. And Twitter, we'll see what the RIF winds up being, but that's occurring as we're taping here. So,
and then Jason, Apple did a pause. Amazon did a pause, right?
And Google and Facebook
Hiring pause.
Yeah, maybe signaling a pause, but haven't. They've been hiring absolutely at a crazy pace. And we'll pull up the chart here. Actually, it's instructive to look at Facebook and Google because they have not slowed down by any stretch of the imagination. Just by the raw numbers, this all started to peak in June and now is starting up again. So there's a website, layoffs.fyi, that's been tracking all these layoffs. You can see the number of layoffs. These are kind of major layoffs and the number of employees impacted. Been pretty consistent in the third quarter. It started to die down in September from the peak in May and June, and now
this is going to spike
to be
this
picking
month,
up.
right?
Yeah, it feels like this is the double dip we were talking about.
I think this is the beginning. This is not even...
Unpack it.
Well, I think that if you take a very balanced view of what happened this week, you have to start, I think, with the Federal Reserve. And really what they said is rates will probably be higher than all of you think, and they'll be higher for longer than all of you want. And again, without debating whether, that's going to come to pass or not, the thing that you can do is you can build a little sensitivity model to understand the mathematical implication of it. And basically what it means is that the dollar that's right in front of you is now meaningfully more important than the dollar that's far, far away from you. So let's just assume that, the Fed funds rate goes to 5.5% or so, even 5. Let's go to the optimists and say it's only going to go to 5. Tech companies have to achieve 500 basis points above that minimum. So we all have to generate 10 to 11% returns for us to be on a risk-adjusted basis better than a government bond. The problem with that is all of a sudden, if you're trying to generate cash even 3 or 4 years from now, it's not worth that much. You need to generate dollars today. And so, they are really reprioritizing the value of short-term profits. And that's going to affect how companies get money, the cost of capital, so how much dilution you have to take. So I think this is what companies are now bearing down for. They're realizing, oh man, I need to get my cost structure way in line. It is way better now, just to think about this contrast. It's way better to grow at 20% and be profitable than it is to grow at 100% and burn money, because it's not clear where that second company is going to get the incremental dollars they need for growth. And that's just a mathematical realization when rates are 5%. Risk-free rates are 5%.
Yeah,
so,
I think this is that moment where you see that pivot from growth to profit.
Yeah.
And,
yep.
We've been talking about it for 6 months, but this is how it is manifest in Silicon Valley companies of scale is through layoffs and cost reductions and cost savings. So the investments in future growth are reduced, and the timeline to drive greater profits is improved. I think what Elon is going to do at Twitter, or what is reported, so this is nothing to do with anything anyone told me, just what I've read in the reporting, is accurate, that he's going to cut so deep, he's going to cut 30, 40, 50% potentially of the employee base. It really sets a new standard for how profitable a tech company can get. And again, I'll give credit to a Twitter poster named Postmarket, who I didn't give credit to a few weeks ago when I read this tweet, which I think was a good one, which was that Elon's really going to show everyone just how profitable these tech companies can be, just how lean they can be run. And, when you're doing a 10% RIF or a 13% RIF, you may or may not even be getting to profitability with that RIF. When you cut 30, 40, 50% deep, and you can actually turn a real profit on a business, an enterprise scale business, like a Twitter or like many other enterprise software companies that are out there right now, it really kind of sets a new standard that a lot of folks might then end up saying, you know what, maybe we should go deeper. And there could be the case that private equity firms take a look at this. And there's a lot of these distressed mid-cap and small-cap software companies out there that private equity firms now realize, wow, you don't actually need 50% of the workforce in order to keep the product running and to drive to profitability. And you could see a bit of a flurry of buyout activity as more folks come in and maybe try and mimic the Elon playbook. So, that's one kind of prediction I think may arise. If Elon is successful in making Twitter a much more profitable enterprise, it could set a new model that catalyzes a lot of other M&A activity, a lot of other buyout activity of these distressed small and mid-cap companies by other actors.
Can I build on what you're saying? Nick, could you please just throw up that tweet that I sent just for all of these guys to look at? Because I think it's incredible. So to your point—
Yeah, this is an incredible slide.
This is an incredible slide. And essentially what it shows for those folks that are not watching this on YouTube is it essentially shows the private software universe and then the public software universe at different levels of valuation. So as an example, right now, there are 15 companies, private companies that are valued greater than $10 billion. And there are 40 public ones that are valued greater than 10 billion. There are 50 companies between, more than 5 billion, but only 60 that are public that are valued more than 5. And here's what's crazy. There are 400 companies who have an average valuation of 3 billion. And then there are already 70 companies in the public markets where they have $1 billion of next 12 months of revenue. And it just goes to show you, to your point, Freeberg, if these folks have to generate an 11% hurdle rate, their cost of capital is 11%, the companies on the left will have to go through a lot of very difficult cost cutting, potentially headcount reductions, repricing of the product, all kinds of things.
And many of them have. Yeah.
No, none of them have.
Oh, of these? Many of these are on the layoff tracker. Yeah, on the left, right.
400. There's almost 500 companies here that have to do an enormous amount of work so that they have a chance to be on the right-hand side of this chart. Yeah. The point is that you didn't have to do this when rates were zero. There was just an abundance of free money and risk-seeking and duration that is now out of the market.
Chamath, I think there's also a story that of the 200 companies that are public software companies that you see on the right, some number of them will need to go private in order to do the restructuring that the market is demanding that they do in order to get rightly valued.
And to your point, it will happen at meaningfully lower valuations than where they probably went public or their last private round. Which will put
as you guys look at these 200 pressure. Companies, as you guys look at these 200 companies on the right, how many of them do you think go private over the next 18 months to get restructured, a la what Elon is showing everyone is possible at Twitter?
18 months is hard to predict, but to your point, Freeberg, I think if you look at the number of them that are unprofitable, at least half of them will have difficulty. So I think about 2/3 of these companies really have no line of sight to profitability in the next 2 to 3 years. And again, if you layer in this cost of capital argument, all of those companies, David, will have to raise money at very egregious terms in order to keep themselves going as a public business, in which case their alternative is to go private in a PE transaction. So it's probably at least half these businesses. I mean, it's a lot.
Do you think there's 100 PE deals to be done?
Yeah.
100 buyout? Wow. Sachs, what do you think? Because these businesses and the models, I mean, some of them, it's hard to get profitable if you're a scaling SaaS business, right? Like you have to get to a certain scale before it's possible.
Well, I don't, that's like a very specific question of like how many of them are going to get acquired by PE firms versus going public or going private after being public. That's like a very specific question. I think the larger point is just that it feels to me like the economy's headed off a cliff right now. I mean, I can tell you within our larger portfolio of companies, like I can see the trajectory. So after Q1 board meetings, I would say about 2/3 of portfolio companies were hitting their numbers and 1/3 were missing. And it still appeared to be like problems related to those specific companies, not a macro trend. I would say after Q2 board meetings, 2/3 were missing and 1/3 were hitting their numbers. And you could start to feel, okay, maybe there's like a macro trend here. And I would say after Q3 board meetings, like now, the entire portfolio is reforecasting. Maybe there's like a handful of companies here or there that aren't. If you're one of those, congratulations. But like even the best companies in our portfolio now are seeing major headwinds. And this is just, I think, an economy-wide slowdown.
Do you think there's restructuring possible? I mean, can these companies—
Well, they're going to have— yeah, because—
let me just ask, in the public markets, do you think those public companies can get restructured as public companies in order to meet
Yeah,
these
it just takes
profits.
the will. Yes, of course. It just takes the
extremely
will.
expensive. Well, it's expensive. I don't even think it's will. I think it's just expensive.
Yeah,
Like, look at Coinbase as an example. Like, look, take Coinbase versus Carvana, right? These are both businesses that issued convertible debt sort of right before things got very, very hard. And if you look at where their convertible debt trades, it's trading basically at an implied yield of about 12 or 13%, both companies. Now, one is probably, a legitimate bankruptcy risk, which is Carvana. That's what the market would think. Whereas the other one, I think it has a very fortified balance sheet and could weather the storm, Coinbase. But unfortunately, in a moment where, rates are, again, the risk-free rate goes to 5.5, our cost of capital to do business goes to 10 or 11. These guys have to pay 12 or 13%. My gosh, it's really, really dilutive to be in business right now. So it just goes to show you that you can stay public, but if you want to get incremental money to cover your burn, the only way you can do it without really, blowing up your cap table and doing a massive recap will be through convertible debt. But it has a huge overhang and you risk turning the keys over to the debt holders of the company. So the alternative for that business is to go into the hands of private equity and get out of the spotlight of these public markets. But private equity is very smart. And the thing that's happened to them is they can't raise debt, right? So what do you think they do? They just have to pay 50% less than what they would be willing to pay before because they have to write, 100% equity check. So there is no free lunch anymore, I think is the big point to point out anywhere in the market right now.
I think one of the things I'm most concerned about, or would be, is I was talking with a friend who works at a private, unicorn software company, and we talked about the numbers of the business, and I was like, oh, that company's probably worth X, and I gave him a number, and then I asked him how much money they've raised, and they've raised more than X. So I was like, dude, your options are worthless. Like, this is a real problem, I think, that's probably going to become very systemic for scaled unicorn software companies. What happens to these businesses, Sachs, in the market, as they kind of need another round, but the value of the company is now less than the total cash that they've raised, that all is sitting as preferred stock?
Listen, it's survival of the quickest. Those who are most willing to adapt the most quickly are going to survive, and the ones that are stubborn and refuse to accept the new regime, the market regime, are going to die. We showed that chart. Remember that chart from Sequoia months ago on this podcast? Remember that? Where it basically showed what happens if you're a company that doesn't cut burn until the very end, then you're still going to run out of money and die. But if you make the cut right away, quickly, you have enough runway to weather the storm. And I think that what we've seen is, at my firm Craft, this is exactly it. Yeah, we showed this months ago. We've been begging our founders to embrace this. We did a review with our entire set of founders of our portfolio companies. We did one in February when we felt the markets were changing, and we did another one in May, and we showed this slide. And this is the most important thing for founders to internalize, is you have to make the changes quickly. One way for them to think about it is, let's say you're a unicorn company, okay? And you raised at the peak, let's say second half of 2021, you raised $100 million at $1 billion valuation. And let's say you've got $50 million left in the bank, right? So you've burned $50 million. A lot of these founders are thinking that $50 million they've got left is only 5% dilution, but that's what it was historically. If you were to raise a new round today, you might only be valued at $250. So that $50 million you have left is actually 20% dilution. And that's if you could even raise, which might be very, very hard. The most important thing founders can do is forget about the historical terms on which you raised that money. Forget about how much money you were burning in the past. Just think about how much money you have in the bank today. Impute a valuation to it so you really internalize how much dilution that money represents, and then create a new plan moving forward to preserve that cash as long as possible.
Can I say something else quickly on top of that? I think that's really good advice. The thing that, again, people should do is you should just build a little spreadsheet for yourself to understand what the alternative financing options are for people who are in the business of investing. So, David, to your point, the current 3-month T-bill rate is 4%. You can buy munis now between 4 and 5% that are triple tax advantaged, right? You can buy high quality corporate bonds that are 6, 7, 8%. And so
you could buy
it's very
stocks that have a dividend yield of 5% of growing market leading
growing.
companies.
And so all of a
5%
sudden,
dividend yield.
exactly. And so all of a sudden, like turning around and giving it to a company where there is no end in sight in terms of it doesn't get you to profitability is a really, really hard thing to do. I was talking to an entrepreneur, David Soloff, just yesterday, and he said it really well. He's like, listen, I'm not a macroeconomist. I'm not trying to forecast, but he's like, what I understood yesterday, this is David talking about the Fed, as an entrepreneur, the angle of attack has changed. The Fed has said this is not going to be some triangle sawtooth. It's not going to go up sharply and then come back down sharply, which is what we would all want if we wanted things to get back to normal sooner. The angle of attack is now a little bit slower, which means it's going to take longer to get where we need to be. And then we're going to stay there for a lot longer than we want. And when you roll those two things together, a lot of companies may run out of money. And so if you can't get to default alive, you have to look at your cost structure and figure out how to right size this thing, because the cost of capital is just going to be really, really expensive.
And this was the Fed's goal, right? They wanted to take away this free capital. They wanted to slow the economy down. And it seems like they're making progress. They did the 75 basis point hike this week, but we're adding jobs to the economy. We have more job openings, and we had 2.6% GDP growth. So I guess my question to everybody here is, what is the Fed going to have to do, or can they stop this consumer and this growth? It's very strange, right?
Powell said he'd rather overcorrect and break things because he has a toolbox to fix the broken bones, but he doesn't have a toolbox to fix if they undercorrect and they have rampant inflation. I mean, not more explicit you can't get, Jason. So he's going to take rates until demand is destroyed, and enough demand is destroyed such that inflation is tamed. But that has huge implications to all of us, because we all have to do our job trying to build a company, trying to raise money, trying to invest money. It's just getting much, much, much harder than I even thought. So for me, I'm like, wow, I thought that we could get through the worst of this by mid-23, but now you have to plan for the worst, which means, okay, now I'm thinking that, man, rates could be higher for much longer, which means, we could be in this market till early 25. And you may say, hey, that's way too conservative. Yeah, but you have to plan for conservatism in this point. So how do I invest money right now? Honestly, I'm like, I should just put it more into T-bills. Isn't that crazy? If a company's like HMOth can have another 10, 15, 20 million bucks, I'm like, wow. I mean, I don't think that gets you anywhere. And oh, by the way, that 10 or 20 million dollars, I can generate 4%. What a tough trade-off, right?
For somebody who has access to private markets, which should be high growth companies, to take the guaranteed 4 over the 50x, 25x, 10x, whatever we're trying to bet on here. Yeah.
It's not just the guaranteed 4, but if you want to take tech risk, then you could go buy the corporate bonds of some high quality companies for the 10 or 11%. So you take moderate risk. So you're also competing with that, not just zero risk.
Can you explain that for the listeners, what that corporate debt is and why it pays more?
Sure. There are high quality public companies, tech companies that have bonds, and that's corporate debt. And they obviously have to pay a higher rate than what the Treasury pays, because the Treasury is risk free and corporations could default. So there is some risk to it. It's not zero risk, but it's like, if you're willing to take tech risk, then why wouldn't you buy a bond at 10%? Meaning the equity always has to beat that threshold return. But hey, can we just go back to the jobs report for a second?
I mean, the U.S. government could default, but it's considered the least likely to default of all issuers of debt in the world. And that's why
they
control
the
printing press.
That's why people call it the risk-free rate, because it is the least risky.
The U.S. can always repay its debt because the debt is denominated in dollars, and the Treasury can always, at the end of the day, print more money. That would just be monetizing the debt. Other countries that owe money in dollars and obviously don't control the U.S. mint, they can't do that. So they could actually default. But since we're the world's reserve currency, we're never going to default. However, the dollars that you get paid back by the U.S. government might be worth a lot less in the future because of inflation. And that's the real risk that you have to think about. But there's no default risk,